Hello and welcome. Jason Weaver here from Weaver Consulting Group. Welcome back for November's 3 and 3 video. What's on the agenda today? First, we're going to be looking at the market correction normalcy, the $7.5 trillion money market opportunity, and lastly, small caps versus large caps. Let's look at market corrections by the numbers. If you notice volatility in recent weeks, you're not alone, and you're not wrong to wonder if it's unusual. But historically, corrections are common and a healthy part of all types of markets. Over the past 85 years, 5% corrections have occurred in 94% of all markets. A 10% correction happens every 18 months. These corrections last an average of about 4 months, sometimes longer and sometimes shorter. On average, the S&P 500 experiences a 10% correction approximately once every 1.84 years. Only about 20 to 25% of the time do we see a correction actually turn into a bear market. The bottom line, market pullbacks are a normal part of the market cycle. It's important to remain objective in these times and avoid letting fear take over. So we're looking at a chart here of the Standard & Poor's 500 over the last 10 years. And you can see the black line represent monthly returns starting with $10,000. And look at the extreme volatility from one month to the next. But if you look at the yellow line and you start with that $10,000, over that period of time, you can see it's actually grown to over $30,000. Now let's look at the $7.5 trillion money market opportunity. That's a lot of cash sitting on the sideline. And you can see as of November, about $3 trillion of that is retail and $4.5 trillion of that is institutional. As the Fed starts to lower interest rates, what's going to happen is some of that cash may start to find its way into bonds and also into stocks. And that could help the rally that's been stalled out since the end of October. So you're looking at a chart showing the historic money market levels at $7.5 trillion. And you can see that we've had levels that have been this high, relatively speaking. But now in 2025, as asset levels have swelled, people have higher values in their stocks, high values in their bonds. Money markets also have some of the highest values we've seen in a long time. What's going to happen if the Fed starts lowering interest rates? That's the question. We'll probably start to see, again, some of that money start to find its way into other investments. Small caps versus large caps and their current valuation. So in comparing the two, as of November, you can see that small caps have a 3.65 average market cap. And they're trading for about 26 times forward earnings. About 1.9 times their price to book. And again, they're growing at 22 to 26.5% growth. Now comparing that to large cap stocks, the average market cap is $116 billion with a 22 forward PE and also a price to book at 4.8 times and an earnings per share of 10.3%. So this could be an opportunity as interest rates start to come down. We may start to see some of those money market investments we've been talking about find their way into smaller cap companies that are trading for a lower price to book. Even though their PE ratios look higher, what will happen is as their actual earnings accelerate, those price to earnings ratios will actually come down. So let's look at small caps versus large caps in historical context going back to 1979. And the light blue line is small caps. And you can see small caps generally outperform after recession. So from 1979, again, small caps did extremely well until we hit that recession in 1981, 1982, and large caps outperformed. And you can follow that graph where large caps are outperforming after slowdowns in the economy, and then small caps are actually starting to outperform as we start to see growth generally pick up. Now let's look at today. This could be an inflection point. Large caps have outperformed since 2022. And with the Fed lowering interest rates and a lot of that cash sitting on the sidelines, maybe those long-term growth rates will start to actually pick up for small caps, and their outperformance could be reflected in 2026 to 2027. Thank you for watching 3 and 3 in November. The takeaways: market corrections are normal. Enormous capital is waiting on the sidelines, and we may be in an inflection point where small caps become more attractive relative to large caps. For questions about your financial plan and whether your portfolio positioning makes sense given these market dynamics, reach out to our team. If you found this helpful, please like and subscribe so you don't miss future updates.